Hello, everyone, and thanks for joining us. My name is Denny Smith, and today is Thursday, September 21st, 2023. Joining me on the call today are Stephen Mullowney, Chief Executive Officer of TRX Gold Corporation, and my old buddy, Bill Holter, one of the premier gold and silver brokers in the world today. They've joined me here today to share information and thoughts on TRX Gold Corporation. Now, Steve has been speaking publicly about TRX Gold at the H.C. Wainwright Global Investment Conference, the Precious Metals Summit Conference. Gosh, Steve, you've gone everywhere. The 35th Annual Gold Forum. And he's agreed to share some time with Bill and me to also discuss the recent accomplishments and future expectations of one of our favorite junior miners, TRX Gold Corporation. Listen, before we get to Steve and Bill in this discussion, please be aware that in our conversation today regarding TRX Gold Corporation, we're not giving anybody investment advice. What we're trying to do is provide a platform for a frank discussion about the company and the opportunities and threats in the current economic and mining environments. But it's very important to remember that your investment decisions are your own, and those investment decisions need to be based on your own personal financial situation and the advice of your accounting and financial advisors. Well, Steve, first off, thanks for sharing some time with Bill and me today.
No, it's my pleasure, Denny, to be on with both Bill and yourself. And I look forward to the discussion, not only on TRX, but what's going on globally and what may impact the gold market. I love talking about those sort of things. As you guys know, in my university career, I did do economics. So it is one of my favorite topics to talk about beyond gold mining.
And it's usually one of the first things we want to forget when we leave college. But Bill, you have been as busy as any of us, and I appreciate your carving out some time for us as well. Thanks for joining us, Bill.
My pleasure.
Well, if our listeners have not been able to hear your presentation, Steve, you've had several of them. Andrew stepped in for you on one of the presentations, but let's start with a quick synopsis of how is TRX doing?
We're doing great. As everybody knows, we are in Tanzania, and we are currently gold mining. We've de-risked the project significantly, particularly over the last 18 months. We're now at 1,000 tons per day, and operating at that level. But the really exciting thing that we did in the last 6 months is really process some of the sulfide ores, which represent 90% of the resources at the deposit. And we put that through the existing plants, and we've achieved really good recoveries on that of over 88%. We get around 90% on the oxides. And that's just that's a great de-risking. We have the rocks as well from a metallurgical study perspective down in SGS South Africa to go through that process that should hopefully verify what we've discovered in our own existing plants. The sulfides have gone through it and continue to go through it today.
Steve, anybody who has followed TRX for any length of time knows that there have been several attempts to accomplish what you and the TRX team have done in the last couple of years. Considering all of that, Steve, is TRX finding more product in the ground right now? And how long will exploration continue? And where's it taking place on the property?
Yeah, so exploration is, always continues on the property. So right now we've pulled back from exploration as we do the plant expansion, and then we'll ramp it up again. But part of that as well is looking at the geological data and figuring out where we should have the highest probability on the next phase of drilling. So with regards to the exploration potential of the property, I've said this numerous times, it is an underexplored special mining license. We've extended the strike length in the south and the northeast of the main zone. It is open at depth as well, and discovered a whole new shear zone in Anfield that's anchored by the Eastern Porphyry in a defunct Chinese mine off the end of the property, as well as the Buckreef West zone. So there's just lots of potential there. What we're going to be doing is doing the expansion. That expansion will increase the cash flow to put more money into the drill bit. And geology, although it can be exciting at times with press releases around results, does take a little bit of time to do.
Steve, when we compare ourselves to our peer group, how do we stack up?
Look, TRX has performed reasonably well in these tough capital markets. I just looked at it in my the companies that I follow this morning, a lot of them are at 52-week lows or near 52-week lows. So relative to the, our peer group, we performed decently well. And I attributed that to, the business plan of putting it into production, utilizing that cash flow to put into the asset, as I presented in the various conferences. We've raised a net amount of $25 million. We haven't done a raise in well over 18 months, but in that raise, now we've invested, I think, over $37 million into the property, and still have $7.5–8 million of cash on our balance sheet. So we've been good managers of capital. We've also reduced our general and administrative expenses in that period as well. So that will be the business plan going forward. I think the market rewards that more than raising money and then putting it into the drill bit, unless you have a really big hit. Most companies tend to oscillate or trade down in this type of what I'll call a high capital cost, tough capital market environment.
Steve, how do Wall Street, all of you at TRX, and investors accurately value a mining firm? How do we go about valuing what TRX is?
Now, you're going to get into a lot of things I used to do in my former job around fairness opinions, evaluation of mining properties, and things of that nature. So it's not an exact science, but there are several methods to value a mining firm. One is its cash flow. So you would have a net present value, or NAV, net asset value of the asset. And typically firms would trade on a price to net asset value. That's one method. The other methods are enterprise value to reserves, enterprise value to resources. You also have price to cash flow, and enterprise value to EBITDA. Those are the predominant methods that you would normally line up on a football chart and see where they overlap in order to determine what the fair value of a company would be. Obviously, in building out our business plan, I look at all those metrics and try to figure out, what's the best way forward from a shareholder appreciation perspective. So in all of those, there's only a couple of those valuation metrics that have shares in it. Like price to cash flow has number of shares in it. Enterprise value to EBITDA doesn't. So you want that ratio to be as high as possible with a lower share count in it. That's the goal. It's a tough, capital intensive business. It's a tough thing to do, but certainly it's always looked at.
Bill, I want to get you in here. You have lived and worked through a bull market in gold and gold mining stocks, but what is the potential of the sector at this point, as recognized by the markets? And looking forward, what are the components necessary for that to happen?
Well, first off, the valuations of in the mining industry is currently as low as I can remember. And it's important to understand that the reason you own mining shares is for the leverage to the price of gold. Typically in the past, mining shares have been 3 times as volatile as the price of gold. So if you saw gold double, you would see triple that in the average mining share. And I guess the best way to put it is there's no rush like a gold rush. When you see a trend begin upwards in gold and or silver, you will see movements in stocks that would make the .com bubble blush. And I say this, go back to the late 1970s. That was obviously a huge move. By the time that was done, I don't think there was a single stock that priced at under $1. And many of those stocks were trading at 1 and 2 cents. So, that gives you an idea. Now, obviously, do you want to put all your money into the mining sector? No. If you understand gold and silver as money, you want physical gold and silver as your foundation. The mining sector, because of the volatility, obviously there's more risk, but there's a huge amount of upside potential. And, you'd have to look at it on an individual basis But for someone to have 50, 60, 70% of their capital in physical metal and then the remainder diversified amongst majors, intermediates, juniors, explorers, that portion of your portfolio will end up dwarfing your foundation.
I'd like to just respond to Bill's point there, Denny. He did raise one thing there, and you and both of you have been through a couple of more cycles than I've been through. But I've been through a couple of cycles here in the mining industry now, particularly gold mining. And yes, the valuations are low. We are in a tough economic environment. And what you want to do in this environment is do what we're doing. Have some cash flow so that you don't need to go to the market and necessarily raise capital for your operations, which then gives you hopefully a lower share count in order to have an increased leverage to when that market turns. And I've seen this market turn a couple times now, and you're right. It is quite volatile on the upside. And you want to make sure that from a shareholder perspective, you have less shares outstanding when that happens than more shares going through the tough part of the market. And that's really the way I looked at it, is I fully anticipated this tough market. We are in a rising interest rate environment. You want to make sure that you have a sustainable operation in this environment. If you don't, then you're not necessarily going to get share price appreciation if that firm needs to go out and raise money to do drill bits. So I think we're positioned relatively well versus other juniors.
Steve, since you're speaking, I'm going to go ahead and ask you that in all the speaking conferences you've attended representing TRX Gold, what is the thing that you have not included in the conference presentations because of a time constraint that you still want investors to know?
I think there's a couple factors that are still missing from a market perspective. I'm going to be taking this back as we revise our marketing materials. One is, as I mentioned, the sulfides going through the mill. There's always an anticipation that there's going to be a huge capital blowout in order to process those. But if we continue to be able to process these profitably and the MET study comes out the way we anticipate, then the likelihood of that is a lot lower than what I think the market really anticipates. So I think that's one of the factors that we need to do a better job of. And another factor is, look, Tanzania is a good jurisdiction. We have the mess going on in West Africa with the coups and with the Russians having more influences there. On the continent of Africa, Tanzania is a really good jurisdiction to do business in. I've been saying that for a while, but I don't think it's really taken its hold as well as it should have vis-a-vis what's happening around the world.
Steve, TRX is
Denny,
just... Oh, yeah, go ahead, Billy.
I just want to go back. Stephen mentioned we're in a rising interest rate scenario. And typically, rising interest rates is a headwind to gold and silver. It's also a headwind to mining companies because their cost of capital rises. And I just want to point out that where we're headed may not be a traditional rate rise scenario. At this point, yes, the central banks have tightened and they have caused interest rates to go higher. Had they not, I believe that the markets would have caused interest rates to go higher anyway, based on the threat of inflation and where we're headed. We may enter an enormous rate rise scenario where the central banks lose control and rates rise based on a risk, if you want to call it a risk adjusted basis or a risk premium. I mean, I think it's possible that the West could actually see 10, 15, 20%, or even much higher interest rates because the debt structure, we're at the point now from a mathematics standpoint. I mean, just look at the US. You're looking at $1 trillion a year or more in debt service. So we very well could be at an inflection point where these central banks lose control of interest rates, they explode, And at the same time, you see the price of gold and silver explode because they're the only real monies on the planet. And their competition will be seen as fake fiat monies that fail.
Bill, you always have a way of pulling my pucker string tighter. And we've all been aware of what's going on, but buddy, you know how to pull it tight. Steve, I want to go back to you because we've just finished our fiscal year at the end of August. What has been your biggest surprise, and how have you and the management team addressed those issues?
Look, the biggest surprise is the company's grown really quickly, right? And so, you know, we have now going back in, we've had a lot of learning experiences throughout the year, and particularly in your first year operations. Now, we've gone through a really wet season. It was like, I think, 2.5 times as wet as normal. And we figured out what we need to do in that, and we could plan better for that. We've also learned, you know, in that environment, processing sulfide ore is better in a wet season than oxide ore because the sulfides have no clay in it, so it's not slippery.
Well, let's explain to people that oxides are dirt, sulfides are rock, and so dirt absorbs water and rock does not.
Exactly. So you have those learning experiences throughout the year, and that's business, right? So business isn't a riskless enterprise. You get challenges and you overcome those challenges. So, you know, the ability of the team to overcome those challenges, I think, has been my biggest surprise, and be flexible. And you know, we put in place 3 ball mills for a reason in a single asset producer. In the fourth quarter, we've had a motor blow. We still produce gold because you know, there's 3 ball mills instead of 1, and so, you know, we built that into the system. But it's the flexibility of the team to really overcome the challenges that we've had in the last year. It's not an easy business.
No, it's not an easy business. Bill, I want to go back to you. You've been an investor in TRX and have shared that enthusiasm with many prospects. Going forward, you know, you're also the broker that connects investors with the physical and precious metals. So, Billy, why would an investor want to hold one over the other? You talked about the multiplication, about the leverage. Precious metal mining companies or physical precious metals. How do you coach people through that, Bill?
Well, I don't think you want to hold one or the other. I think you want to hold both. And the percentage between physical gold versus mining shares, it's a personal preference how much risk you want to take. The idea with holding mining shares, and what I just talked about a couple minutes ago, the possibility of the end of fiat, a credit default deflation scenario. The reason you want to own mining shares, because if the world does, or I should say when the world does move toward currencies that are backed by gold, not 100% backed, not convertible, but on a ratio basis, what that will do is go back 100+ years when mining companies basically were considered like utilities. The whole idea, I think, going forward is that if you're holding mining shares with good properties that are in production, you really own a percentage of the printing press, if you want to call it that. I think mining shares are going to become banks, if you will, or suppliers of money to the system. So I think the importance of mining, the mining industry, is going to jump many fold simply because of where we're going financially. And I think where we're headed is the end of fiat, the end of confidence. Confidence is going to break.
Yeah. So Bill, you know, you bring up the point around being in production versus not being in production. I've seen, and this is maybe one of the first times I've really seen the differences. I think the spread is a lot greater than it used to be. Is investors have kind of taken the view that if gold can't come out of the ground in a property, then it's not very valuable. And at this particular point in the market, that may change. I remember going through 2008 to 2012. You know, so you got to continue to drill it out and have gold in the ground as well. But right now, in the current environment, investors certainly are valuing more mining companies that have it coming out of the ground at a decent cost, versus just being in the ground and being a development play and a development story. It's an interesting, I think I haven't done the numbers, but I would suspect that it's a pretty wide margin, and maybe one of the largest margins that we've seen between the valuation between both types of non-producing and producing properties.
Right. Back years ago, companies were valued more on their reserves than they were on what the production was. And Steve, you know I'm a property guy. The property, Buck Reef itself, is the reason I got involved with TRX, because I believe that the amount of ounces in the ground is many-fold over the 2 million. That's why I got involved. And ultimately, at some point in time, there will be bidding for properties just based on what's proven in the ground, and even what, blue sky, what's potential in the ground. So the pendulum is swung totally away from ounces in the ground. And the next move is toward, valuing companies, purchasing companies, coveting companies that have ounces in the ground. And production won't be as important as it is now. I mean, production is important now because companies have to stay in business.
Correct.
But once the speculation comes into the gold and silver markets themselves, then that speculation is going to bleed over to where can we find ounces in the that'll be a bonanza.
Yeah, and I look forward to that day because, again, as we referenced earlier, we've seen a couple of these cycles. And if you're in production at this part of the cycle, you can invest that capital into the ground in order to get your resources and reserves higher over time without having to raise money today to do it, which hopefully we can get that leverage in the future on our particular property. And that's the business plan.
It is. Steve, the last question I have, in recognition that we are indeed mining money, I think I've heard Bill say that 100 times, that the one thing about the gold mining business is that you are actually digging up money in one way or another. So here's the last question, and it has to do with your capitalization. $7 to $8 million is adequate for operations if we're just an ongoing business. But for full development, there are other issues about capitalization of TRX. And do you see corporate needs for additional capital that mining operations will not be able to supply going forward?
Yeah, look, that's a good question, Denny, and I get asked that question all the time. And so, I always want to make sure that there's different capital options to fund a business. So, for instance, in the next expansion, we've said it cost around $6 million. And so the options that we have to finance that are some cash flow from operations. There's a significant stockpile on the property and go through shortly thereafter. We are talking to Tanzanian banks, and we should be advancing that very shortly. And we also, as you know, have access to gold forward sale financing as well. So there's a plethora of different financing options for that. And then expanding beyond that, after that plant's up and running, the cash flow is a lot greater than it is today. And we'll do an evaluation of what's shareholder accretive. Is it going slower or is it going faster? And how can you capitalize that? And also the EBITDA is going to be a lot higher, which means the ability for it to incur bank debt is higher. And so we're prudent in looking at all the different capital options. If we were to do a capital raise, it would be done because I see shareholder accretion as a result of doing it, moving up cash flow in the ability to do that. And that plan would be, marketed versus raising money for G&A, which I think a lot of companies are in that position. As I said earlier, we have a multiple on the cash flow that we've already raised. I think it's around 1.5, 1.6 invested into the asset, and that continues to grow as a result of the cash flow coming from the asset. Most juniors, that would be below 1 because they have G&A to cover. And so that's the kind of the view that I take. Any plans for expansion would be well telegraphed to the market and how much that would cost and what the financing options are around it. And it would be shareholder accretive, or else you wouldn't do it.
You are deserving of a lot of compliments, but I will say this. You are tighter than the skin on a watermelon in the way that you have financed your capital improvements, the mills, all of the equipment, conveyors, everything. You are so tight, Steve Mullowney. And I think that has served you well. And so people know that when you do go to the markets for capital, it will probably be for a doggone good reason.
Well, I have a good colleague down the hall that manages cash fairly well and is on top of it in Mike Leonard. But
oh, you mean your mother? That's your mother-in-law down the hall. I know who that is.
Yeah, exactly. So, but you have to look. It's a capital-intensive business. You got to be on top of it, or else it could kill you. Literally. So,
or you'll embarrass yourself in the markets, and that's the last thing you want to do. As an investor and as a financial guy, one of the things I've really appreciated is that little by little, this whole project at TRX has been de-risked. And Bill, you had some thoughts about the de-risking of TRX as an investment.
Right. For many years, I mean, I got involved in TRX back in 2015. And the goal from that point forward had been production. And production didn't start until late 2020, 2021. And it was always a nervous time not having cash flow, and the company continually had to raise funds to continue. And the risk at that point, obviously, was losing the mining licenses. And at this point, I sleep very well at night. I'm extremely comfortable because there is cash flow, and the risk of losing the gold or the leverage to that gold in the ground doesn't really exist now. So I mentioned this to you before the call. Do I like the stock price? No. Does it bother me? Am I concerned about it? I really don't care what the stock price is at this point because I know where the big picture goes. And in the big picture, you want the leverage to gold in the ground, and that's what we've got here.
Well said, Bill.
Thank you for those comments. Thank you for those comments, Bill. Thank you very much.
All right. Well, that's about it for our call today. Bill, I want to reach out to you. If people want to find you or learn more about you, how can they find you?
You can go to my website, billholter.com. I will post this on my website. Not sure, how many other websites will carry this, but it will be posted on top. I think we'll put an icon there just to keep this fresh for a month or so.
And again, Bill, thank you very much for sharing some time with us today. Also, if investors are listening at this point, you want to reach out, Christine Lally under Investor Relations. And Steve, I got to give you credit. You always return emails, no matter who the investor might be. You want to give out your email address?
Yeah, you can find it on the bottom of press releases. It's s.mullowney@trxgold.com.
Well, to both of you, thanks a lot. Again, my name is Denny Smith, and joining me today on this call has been Steve Mullowney, the Chief Executive Officer of TRX Gold, and my buddy Bill Holter, again, one of the premier gold and silver brokers in the world today. Gentlemen, thank you very much for your time.
Thank you, guys. It's a pleasure, as always.
Thank you, Denny.